principles are the core of our being. We live by certain rules, beliefs, and ideologies that are available to a general populace, but in the center of our being, we adhere to specific principles that govern our behavior, philosophy, and action. These principles shape habits, habits shape routines, and routines shape a particular lifestyle. Investing in itself is a lifestyle, and the key to any successful lifestyle is a set of good principles that can withstand any challenge and trial. In prosperous times, almost all investment options perform well, and investors reap positive returns. However, it's in times of economic turmoil that investors truly recognize the importance of adhering to core investment principles. These principles hold immense significance, although only a select few are acquainted with them. Welcome to Luxo-Life, your partner toward personal growth and success. In today's video, we'll reveal 15 key investing principles that only successful investors know and practice. The world is going crazy left and right. Natural disasters, wars, and pandemics shook the world, and the economic sector has been deeply affected. Yet, some rich individuals managed to keep their wealth, even grow it. So, how did they do it? Now is the best time to learn more about investing as we weather through the greatest economic storms of our generation. So, take a seat, grab a pen and paper, and watch this video until the end. Let's get started. Number 15. Having a financial roadmap. For starters, it's crucial to review and analyze your current financial situation. If you've never done this before, now's the right time to try and get used to it. Evaluate your current financial status, gauge your risk tolerance, and set your objectives. It's much easier to get things done when you have a proper plan. Whether you're working it out with a professional or proceeding solo, this is the foundational step. During this process, maintain unwavering honesty. Although it might sound cliche, transparency is vital. Knowing your actual financial situation or means of living allows you to live below your means, cutting off unnecessary expenditures and putting more money on important matters. Maybe a $20 subscription to a movie service has to be put on hold, and creating an auto debit arrangement for your electricity bill is a bright idea. Setting your risk tolerance is just as important. We despise limits, but risk tolerance assessment is based on strategy, not fear. Your risk tolerance may also vary from investment to investment. You might feel like you can invest more in bonds and fixed income securities, but more averse to high-risk stocks and cryptocurrencies. It's best to only invest what you can lose. Lose the battle, win the war. Success is not guaranteed, but a well-structured roadmap increases your odds of profitability. As long as you're aware of your objectives and where you are on that roadmap, you can stay on track and overcome adversity. Number 14. Investing early. Early investors often have the time advantage. Research and market analysis reveals that investing early and frequently is more effective than waiting for a lump sum. It's a common beginner's mistake to wait until the market gets better, but only experienced investors invest routinely, knowing that time is on their side. Initiate with your current resources and gradually construct your portfolio. Early investing capitalizes on the power of compounding, utilizing earned money to generate more. Consequently, your profits comprise accumulated capital gains, interest, and dividends. These are often gained from the passage of time. A mere 2-year lag in investing can lead to substantial potential losses. Number 13. Establishing a time horizon. Setting your time frame is essential when it comes to investing. It's a common mistake for people to invest a lot now and end up worrying about a bear market because they've suddenly lost a lot of money. Whereas investors who know for how long and when they'll need their money leverage off a bear market to buy assets at discounted prices. Understanding your time horizon is key to long-term investing, and this allows you to craft an effective investment plan and portfolio. Establish your time horizon and be more prepared for the onslaught of bull and bear markets. Learn to sail with the tide and not against it. Remember, time is on your side. Number 12. Using diversification to reduce risks. The art of diversification is a skill mastered by many successful investors and wealth managers. The axiom, "don't put all your eggs in one basket," is a fundamental investing principle. The more you diversify your investments, the less likely you are to lose them all. Diversification is a simple strategy that others may shun because they believe they can't afford that many investments. None can be further from the truth, as no matter how much or less money you have, you can invest in diversified assets. If you invest based on percentages of your income, it becomes possible to invest in multiple funds. Some funds will even let you invest for as little as $20. You can also automatically diversify your investments with index funds like the S&P 500 and the Nasdaq index funds, or with exchange-traded funds, or ETFs. Imagine buying one investment security and yet owning a share across multiple assets. That's the power of diversification. You have the potential to earn more from multiple investments while also mitigating your risks. So, even if one or two investments fail, you can still sleep well at night knowing your other investments are safe. Number 11. Dollar cost averaging. This term refers to investing at regular intervals or routine, regardless of price changes. Beginner investors are often blindsided by the common theme of buying low and selling high. While the notion holds, there are advantages in investing at regular intervals because you're more likely to build wealth that way, especially if you're a beginner or an investor who is less inclined to micromanage assets. Dollar cost averaging aims to weather the overall volatility of the market by regularly buying assets and reducing the average cost per share. This means that you invest a set amount at regular intervals, so you buy more shares at low prices and fewer shares at high prices. In the end, you consistently grow your wealth while avoiding lump sum losses and the sway of emotional investing. Number 10. Rebalancing for profit. While dollar cost averaging is a valuable investing routine, you can also try other strategies to suit your investment horizon, risk tolerance, and financial goals. One such strategy is rebalancing for profit, or the means of adjusting your assets to capitalize on fluctuations. This could involve selling assets when the prices are high and buying assets when the prices are low. Rebalancing allows you to preserve your capital, increase profits, decrease risks, and identify new asset allocations that will prove beneficial in the long term. Number 9. Cushioning with conservative bonds. Bonds offer vital portfolio support during market turbulence. They cushion against value drops, granting withdrawal options from assets unaffected by plummeting value. One good example would be the often observed inverse relationship between stocks and bonds. When stock prices are high, bond prices are low. But when stock prices plummet, conservative bond prices increase, which makes bonds a safe haven during economic storms or crashes. Purchasing bonds when they're low is a good diversification strategy that also serves as a financial reserve when stocks fail. Number 8. Balancing risk and return. Balancing high returns with low risk is challenging, as high reward often comes with high risk. So, most investors would seek that sweet spot of getting high returns with the least risk. Risk manifests as illiquidity, poor credit, or leverage. Economic shifts also affect risks. Some of the best ways to mitigate risks and achieve desirable returns are diversification, asset relocation, and rebalancing. Number 7. Scrutinize fees and taxes. Brokerage fees and capital gains taxes impact overall returns. Assess brokerage commissions before decisions, as they can stack and chip off a substantial portion of your investments. Additionally, be aware of jurisdiction-specific regulations concerning capital gains tax to make sure you're within the safety of legal boundaries. Number 6. Watching out for fraud. Fraud is pervasive, with scam artists perpetually seeking their next victim. Shield yourself from falling prey to their schemes. Fraudsters often exploit widely publicized news to ensnare investors with seemingly irresistible opportunities. To avert this, pose numerous questions, request official documentation, and involve legal consultation before investing. Number 5. Managing debt. Debt holds both positive and negative facets. It proves advantages when employed for investments, not expense coverage. High net worth individuals often amplify their wealth through strategic debt use. Nonetheless, individuals in optimal financial standing are typically debt-free. Prudent monitoring of debt is paramount to avert complications. If debt is necessary, exclusively allocate it to investments, not personal expenses. Create a comprehensive plan for debt elimination. Number 4. Investing isn't gambling. Many people often liken investing as a form of gambling. You can either win or lose money, and it can be addictive once you've made a substantial profit. However, investing requires careful planning, strategy, and execution. It's an honest and laborious means of gaining money. We must never lose sight of our investing and financial goals and be swayed by our emotions. Many investors have lost significant amounts of their wealth because they went by the investing hype. Once you've reached a specific goal or amount, it's best to be content and follow your exit strategy rather than suffer the potential capital losses of overstaying and the stress that comes with it. Always be a wise and disciplined investor. Number 3. Leveraging for wealth. Leverage is a great tool for amassing substantial wealth. This allows you to benefit from other people's resources and broaden your scope, ethically, of course. To cultivate massive wealth, leverage becomes essential. Various forms of leverage exist: financial, time, knowledge, systems, and technology leverage. Financial leverage allows you to benefit from other people's finances, such as loans, partnerships, and sponsorship. Time and knowledge leverage allows you to employ other people for their time, knowledge, and skills. These are key to building and expanding your business because there's only so much you can do alone. Systems and technology leverage work almost the same as the previous, except with these, you're leveraging off of others' existing systems, tools, and technology to grow your business and wealth. Think of it as how we're all benefiting from AI technology or established marketing systems. Employ other people's finances, time, expertise, and established systems to your advantage. Number 2. Understanding the power of cash. Recent events like the pandemic, the war, and natural disasters made us realize the indispensability of a cash reserve. Before any financial planning, establish a cash reserve equivalent to 3 to 6 months' expenses. This emergency fund will come in handy when you're faced with the worst events like another pandemic or a sudden natural calamity. Otherwise, be prepared for temporary predicaments such as job loss or hospitalization. Compile a comprehensive list of expenses and corresponding amounts to ascertain your monthly expenditures. Those who possessed reserves during the pandemic remained relatively unscathed by economic upheaval. Reserves serve as a lifeline during unforeseen changes, and cash is the best form of financial reserve because it's immediately liquid and accessible. Just make sure to store it somewhere safe and secure. Number 1. Slow and steady wins the game. Humans are always entranced by what is new and hip. We can make irrational decisions on a whim just by being emotionally excited. It's the same pitfall when it comes to investing. Investors are always chasing after the next big thing. In this case, we lose sight of our goals and fundamentals. We must stick to the sure and steady path to avoid the risk of losing our emotions and incurring unnecessary losses. Discerning between exciting and viable investment opportunities is essential. Carefully analyze prospective opportunities and adhere to conventional investments like index funds, blue-chip stocks, and high-grade bonds. While this approach might bypass fleeting trends, it secures stable returns. If you liked this video, please leave us a thumbs up and subscribe to the channel for more awesome and educational videos on finance and self-improvement. Thanks for watching!